Hello everyone, thank you for joining us today and welcome to this presentation of the right way to trade tops and bottoms. Welcome, my name is Stephen Primo. I am the president and founder of Specialist Trading. If you're new to my website, I'd like to just inform you that we are unlike other websites in that all we focus on is education. We are an educational company first and foremost, meaning that we take all the tips, techniques, and strategies that I've accumulated in my 38-year trading career, and then I teach and mentor all of my students so that they can ultimately empower themselves with this information, hopefully shorten your learning curve. I've been trading, as I said, for 38 years. I started my career on the floor of the Pacific Stock Exchange. I was on the floor for a total of 16 years, and 9 of those years I was a specialist. If you're not familiar with what a specialist was, they're simply those gentlemen that used to make markets in roughly about 50 stocks. If you ever see those old pictures of people on the trading floor screaming and shouting with paper all over the place, the specialists were those gentlemen who made markets in about 50 stocks. So if you wanted to buy or sell those particular equities, you had to go to the trader who specialized in them. I traded once again on the floor during the crash of 1987 and the bull market that followed. I've traded in just about every market environment imaginable. I've seen everything, every system, every trading strategy. So in my 38 years now, I think I'm pretty qualified. I know what works in terms of consistency and I know what doesn't. So that's what I'm going to focus on today. I'm going to show you why I feel why the majority of most people fail while trading is because we're relying on conventional wisdom that really has no basis in consistency. Once again, I know this from firsthand experience because when I first started trading, I used to rely on these and use these traditional methods. But as I saw later on in my career, they really weren't helping me at all. It wasn't until I started just relying on the market itself, what the market was telling me, on just very, very basic trading techniques, that's when my trading started to become consistent. So this is what I'm going to share with you today. In fact, I'm going to really be giving you a technique I learned over 30 years ago on the trading floor. This is an entry technique. It's not a full-fledged strategy, but you can apply this technique to any strategy you're currently trading, or if you're so inclined, you can actually build a strategy based off this. So get out your pencils and paper. This is going to be a really informative presentation. But before we begin, I ask that you please take a moment to view our disclaimer. We are required to show you this. So would you please take a moment to view it? I'm going to show you a lot of performance results using this entry technique. But please remember that we can in no way guarantee that any of the results I'm about to share with you will be repeated in the future. So as you are taking a moment to view our disclaimer, I would also like to take this moment to invite each and every one of you, if you haven't already, to follow us on Twitter. Here's our handle. You may want to write that down, at SPCLSTTRADG. I post information on a daily basis there on our Twitter page, anywhere from daily financial wisdom, little tidbits I've accumulated along the way, to actual signals that our strategies have currently generated. In fact, I posted just today, I posted a strategy that one of our Forex strategies generated in the dollar-yen. And then 2 days ago, I posted multiple buy signals that were generated in the E-mini or the markets, the S&P 500. And as you can see, the market went up very strongly after that the last couple of days. So even though we don't post you the actual entry signals and stop levels, we let you know once our strategy has generated some type of a signal. So there's lots of great information to follow us on Twitter. Although it's rather brief, it's not very detailed. If you would like to get more detailed information about what we do, well, my sister site, which is Pro Trader Strategies, they market and promote all of my courses. They've put together a Facebook page. So you can go to Facebook and you can simply go to Pro Trader Strategies, and they have a lot more detailed information, anywhere from real basic studies to actual videos of mine of me teaching different techniques on their Facebook page. So Pro Trader Strategies is my sister site. All right, so as I stated right off the bat, we are an educational company. We're unlike other websites, whereas we don't simply want to force feed you signals. We don't want to simply tell you what market to trade, what's the perfect time frame, what's the perfect entry level, what's the perfect exit. We really don't believe in that. We believe that what we should be doing is basically supplying you with information that has stood the test of time, and then mentor you along the way so that ultimately you'll understand it and be able to apply it so it fits your own persona. That, in my opinion, is the only way someone can become consistent in the markets. And I say this from firsthand experience. When I first started trading roughly 38 years ago, I was doing everything I had been taught to do. I was reading all the books. I was going to all the seminars. We didn't have chat rooms or trading rooms then, but we had newsletters. I subscribed to each and every one of them. And guess what? I couldn't make a dime. I was doing all the traditional things, but nothing seemed to work. Sure, it would work every once in a while. I would have maybe 2 or 3 good trades, maybe even 4 or 5, but it was always the next one where I'd give everything back. And I'm sure a lot of you can probably relate to that tonight. There's no consistency in these type of traditional methods. And I'm going to share with you a method today that was born out of that. But the basic philosophy behind specialist trading is that we are an educational company, and I want to teach you, as you see here. I don't want to trade for you. I don't want to tell you where to buy, where to sell, what the perfect market is, but I want to teach you how to trade with the specialist edge. This is the same edge that turned my trading around over 30 years ago, and hopefully it will be able to turn your trading around as well. All right, now this is going to be a really good presentation. I'm going to give you a lot of information. So the one thing I would like to state is if you have any questions, kindly wait till the end of the presentation. It'll probably be in the next 20-25 minutes, and then we'll take questions and answers then, okay? So if you have a question, please just wait, and we'll get to it at the very end. The only question I will answer is the most popular, and is this being recorded? Yes, it is. We record all of our presentations, so don't worry if you have technical difficulties or if you have to leave early. Kindly request a link to this from Pro Trader Strategies, and they will send you a link to this recording. All right, so yes, just please ask the questions at the very end of the presentation. And why don't we begin? Let's start out by sharing with you how most people trade tops and bottoms. After all, we're going to show with you what we feel is the correct way to trade. And let's show with you how most people trade tops and bottoms, myself included. When I first started trading, this is the way I used to trade. All right, we're going to look at some older charts right off the bat just for educational purposes, but then as we proceed on with the presentation, I'm going to share with you some charts that are as recent as yesterday, okay? Now let's start out with stocks. Traditionally, if someone is trading an overbought, oversold market, what you do here, as we see here in this older chart of Caterpillar Tractor, you want to have some type of a tool or indicator that tells you or deems when the market is overbought, in other words, it's too high, or oversold. So what I've done at the very bottom of this chart here is I've just simply plotted a stochastic oscillator. This is your standard slow stochastic. Now, I have not edited anything. In fact, I didn't even open up. All I did was click on slow stochastic, and it appeared at the bottom of the page. So the only parameters I'm really aware of are the overbought and oversold. So this upper threshold, this blue line here, I believe is 80. The lower blue line is 20. So conventional wisdom would tell us anytime these two lines get above and cross over, we are now in overbought territory, meaning that we've gone up too fast, too high. There's no reason for us to be this high, and it's time for price to settle back down. And conversely, when price gets below, or I should say the indicators get below this oversold threshold, well, we've come down too far too fast. There's no reason for us to be this low, and price usually is going to bottom out. So this seems fairly simple. All we have to do is follow this tool. And remember, it doesn't have to be a stochastic, slow stochastic as you see here. It can be any other type of overbought, oversold oscillator. It can be something that you've formulated yourself. It can be someone on TV telling you the market's overbought, oversold. It can even be based off of the full moon. It really doesn't matter. All that matters is that something is telling you we are too high or either too low. Okay, so if we use this very basic slow stochastic, we see here that when price is below and above, that's our triggers. Okay, so as we see here, when we're in the so-called oversold area, this is where you normally want to buy. So let's just say you stepped in and bought Caterpillar Tractor here. Well, guess what? It went up fairly nicely over the next week. And if we're tracking the indicator, now we're in the so-called overbought area. So when the lines cross, that's our signal to sell. So you exit your long, and now you go short if you're an aggressive trader. And guess what? It's working like magic. Now we're going lower. So we track the indicator, and as it goes into the so-called oversold territory, well, when the lines cross, that's your signal to buy. So you cover your short, and now you go long. But this time it doesn't work. So you're thinking like, what happened? Well, maybe it'll work more if I buy some more, because the lines have crossed over again. So I'll purchase in and double down. And you buy some more, and it goes even lower and lower until ultimately everything you made on the first couple of trades you've given back. Does that look familiar to anybody? I know it does to me, because that's exactly the way I used to trade when I first started trading. In fact, it just doesn't apply to stocks. Let's look at the E-mini S&P. Once again, these are older charts just to show you this concept in action. Let's use the same overbought, oversold tool, but now we're looking at a different market and a different time frame. We have a 5-minute older chart here of the E-mini S&P. All right, same stochastic, same overbought, oversold threshold. Obviously, when we're in the overbought, when the lines cross, that's when we sell. And lo and behold, it works like a charm here. It goes lower. And when we get into the oversold, we cover our short and buy. And guess what? It goes right up after that. And now when we're in the overbought territory, well, we sell. So at this rate, we probably think we're going to retire in about 6 months. It's trading is just too easy, and we're all excited about all the money we're making. So now you're short, but this time it goes higher. So you decide to sell some more, and some more, and some more, until ultimately you've given everything back once again. Same exact scenario. Just like I said, it'll work a couple of times, but then the next time you give everything back. In fact, this same phenomenon will transfer over onto currency trading. All right, let's look at the currency pairs here in the Forex markets in this older chart of the Swiss franc. Same overbought, oversold tool. This is the slow oscillator. As we see here, we are in the so-called overbought territory, so we decide to sell. After all, we've been going up for a while in the Swiss franc. It's got to come down. It's way too high. All right, so you sell. It goes sideways for a while, but then goes back up. And guess what? We never went in the oversold, so the lines cross again. So you figure like, well, this time it's going to make it. So I don't need it to go down that much in order to break even. So I'll probably make even more. So now you sell some more, but this time it goes even higher. Now you sell some more until ultimately you're probably wiped out at this point, because unlike the first two examples, you don't even have a winning trade here. You have nothing but losses. Okay? So this is the way most people trade. This is conventional wisdom. This is the way I was always taught, and this is the way you'll still hear educators teaching you. How many times have you heard in presentations or even today on TV people saying the markets are overbought, the markets are oversold? It happens all the time. But as we see here, things will be overbought and oversold for a while until they aren't anymore. They'll continue to go higher and higher and higher and lower and lower and lower. So how do we trade overbought and oversold? Well, my mentor saw how much I was struggling when I was trading this style over 35 years ago on the floor. I was doing all the things I had been taught. I'd gone to all the classes, and nothing was working. All right, I'd have a couple of good trades, just as you saw, and then I'd give everything back. And here's what they taught me. It took me a while to grasp this concept, but ultimately, this is what got me on the road to being consistent. And they said, Steve, you must grasp this concept if you want to be successful. And that is, there is no such thing as overbought or oversold. Okay, I'm going to repeat that again. I know a lot of you aren't accepting this right now, just the way I didn't accept it over 38 years ago. But there really is no such thing as overbought or oversold. We hear it all the time. This market is too overbought. This market is too oversold. But trust me, markets will go as high as they want to. We've all seen issues, equities, currency pairs go as high as they want for weeks, months, years. Wouldn't it be silly to continue to try to sell, to continue to try to short it? Conversely, we've all seen markets go as low as they want for weeks, months, or years. Remember Enron kept going lower and lower until it finally just, disbanded and went to zero. The whole thing went bankrupt. So it's really silly. It's a gambler's mentality to think that we can pick the exact moment when these things are going to turn around. Sure, it may happen every once in a while, but it's very, very difficult. I know of a few traders who are able to trade this way, and they make a very nice living. But guess what? They're probably 1 or 2% of all the traders on the planet. The rest of us, the majority, the 98% of us, myself included, find it very difficult to trade this way. This is why most people do not make money trading traditionally overbought, oversold. So, once I finally grasped this concept and really let go of the traditional wisdom of trading overbought and oversold, well, I started to become consistent. So, at the time, though, I was with my mentors, and I said, okay, I understand there is no such thing as overbought or oversold, so then how do we trade them? And they said the right way to trade tops and bottoms is simply to go with them. I know all of you are saying, well, what does that mean? All right, well, this is the technique I'm going to be sharing with you today. This is an entry technique, though. Please remember that. I know a lot of you are probably going to be saying, gosh, Steve, this is great, but where do I exit? Where do I place my stop? Where do I, how many shares, how many contracts? What's the money management? Remember, those are all important pieces of the puzzle. They're all great. But those are all pieces of the puzzle that make up a strategy. I'm not giving you a full-fledged strategy today. I'm only giving you the entry. But this is probably 99% of trading right here with this entry technique. So you'll see how powerful it is just on its own, okay? All right, so let's begin by sharing with you what was taught to me over 35 years ago. Let's look back at that same chart once more, the caterpillar tractor chart, that older chart with the slow stochastic plotted on the bottom, okay? Now here's what my mentors taught me. They said, Steve, regardless of what market you're trading, regardless of what time frame, if it's a 5-minute time frame, if it's a tick chart, if it's a monthly bar, it absolutely makes no difference. What you must do is plot a 50-period moving average. And then you ask yourself, where is price in relation to the 50-period moving average? If price is above, well, then the overall trend is up. And if the overall trend is up, then you only want to be a buyer. But as we see here, if price is below, then the overall trend is down. And then we only want to be a seller. So do you see now, by just applying this simple tool that doesn't cost you any money, that virtually everyone has on their charting software package, just by applying this, you, in my opinion, eliminated about half of your losers. Why? Because you're on the right side of the market. So instead of trying to pick bottoms, the only thing we're going to be doing now is selling. Okay? It's that simple. All right, since we're selling, well, how do we apply our entry? Well, we go back down to the overbought, oversold tool. Remember, it doesn't matter which, I don't want you to get hung up on thinking it has to be this slow stochastic. It could be any other oscillator. It could be something you created. It could be something that another educator has, okay? The point is, we want to identify all of the so-called oversold conditions, as we see here circled in red. Why are we locating those? Because we know that there's no such thing. We know now that there's no such thing as oversold, so we're going to exploit it. So here's the so-called oversold areas in red. Now we want to identify all of the bottoms that were created in the stock while we were in the so-called oversold area. And these are all the ones here with these little small red horizontal lines. You see how we made a bottom right here, and it corresponds right to the oversold. And these bottoms corresponded to the oversold, okay? Now there were some other bottoms that were created, but they weren't in the oversold, so we're going to bypass those. We only are interested in short-term bottoms created in oversold conditions. Why? Because we're going to exploit them, because we now have come to terms and realize there's no such thing as oversold. So we're going to exploit them. And in terms of what we're going to be doing is, the minute we trade 1 or 2 ticks below, that's when we sell. So do you see now, this is our entry. We are simply going with the overall trend, and we're going in the direction of the 50-period moving average, and we are exploiting oversold conditions. Now before, where we had a couple of winners, and then we gave everything back and had a series of losers, now as you can see, we have nothing but winners in Cat Tractor. All right, let's go to the E-mini S&P. All right, once again, what is the first thing you do? It doesn't matter whether we're looking at a E-mini chart and it's a 5-minute time frame. Absolutely makes no difference. We plot a 50-period moving average. And we ask ourselves, where is price in relationship to the 50 period? If price is below, we're only going to be sellers, just the way we were in Cat Tractor. But on this 5-minute chart, the majority of price is above. So what are we going to be doing? We're going to only be buying. We are in no way going to be trying to sell. We don't care if someone is screaming on TV that the E-mini on a 5-minute time frame is oversold. We don't care. Why? Because the market is telling us it's not oversold. The overall trend is up, and there's no such thing as overbought, I should say. So we're not going to even listen to that. We're just listening to the market, which is the only thing we really should be listening to. So if the overall trend is up, we're going to exploit the so-called overbought conditions. Why? Because we know now the reality is there's no such thing as overbought. It doesn't exist. So now that we know where the overbought areas are on this oscillator, we simply identify all of the short-term tops that were created in the so-called overbought conditions. And once we trade 1 or 2 ticks above, that's our entry point. Why? Because we're simply exploiting where most people think we're going to be stopping. And before, where we had a couple of winners and then we gave everything back, now we have nothing but winners again. Okay? Finally, let's look at that example in the Swiss franc. All right? Now, this example earlier, when we were trying to use conventional trading of tops and bottoms, what do? We had nothing but losers because we kept trying to short the market, and it kept going higher and higher, as you see here. But what if we had just simply applied that first basic rule of applying the 50-period moving average? Now that you know how to apply this rule, would you have been shorting the Swiss franc? No, you would not even consider shorting it. I don't care if somebody in a chat room is telling you that we've reached some Fibonacci level. I don't care if somebody is saying that the institutions are selling, or if somebody is saying that economic conditions say that the Swiss franc should go lower. It doesn't matter. The only thing we should be listening to is the chart in front of us. It's a lot cheaper. It's a lot easier to understand. You don't have to rack your brain trying to figure things out. It's right there. It's cut and dry. Price is above the 50, so we're only going to be buyers. That's it. Half of your losses have just been eliminated. All right? So now, since we're buyers, we want to locate the so-called overbought conditions circled in green here. Once we locate them, we identify tops that we created, and now we are buying once we trade 1 or 2 pips above. Where before we had nothing but losing trades in this because we were trying to trade traditionally overbought, oversold, now we have nothing but winning trades. All right, so do you see how simple this is? Why? Because for the first time, we're not holding on to conventional wisdom. We're not holding on to what people have told us is supposed to work or the way the markets are usually run. Because we know there's no such truth in that. It doesn't work. There's no consistency. The real truth is listen to the market. The market tells you everything you need to know. So that's the only thing we should be listening to. And it's a lot cheaper too. You don't have to buy all these indicators. You don't have to buy all these programs. It's all that right there in front of you. Just plot a 50-period simple moving average. Okay? All right, so that's the basic concept. Now you have it under your belt. Let's look at some more recent charts now so you really fully understand it and see how it's worked and how it can be applied as recent as just a few days ago. All right, so let's look at some more examples. Once again, let's start out with stocks for all you stock traders. All right, here's an example in RAI coming into November, all right, just a few weeks ago. Where is price in relation to the 50-period moving average? Where is the majority price? Price is above, so we're not going to be selling, right? Once again, don't worry about what outside sources are telling you. If the whole world is saying sell, don't listen to it. The only thing you should be listening to is the chart in front of you. And the chart in front of you says, listen, we're above the 50 period, so we're most likely going higher, so why don't you just jump on board, okay? So how do we jump on board? Well, if we're going higher, we want to locate the overbought conditions. It's that simple, all right? So now that we've located them, we simply identify all the tops, and once we trade 1 or 2 ticks above, that's where you enter. Now what we tell our students is you'll get the most bang for your buck on the very first setup if you use this entry technique. So had you entered right here on this very first setup, you would have roughly made about 7 points, or you would have had 7 points in your favor in the next month, going all the way into November. Okay, not bad. A nice percentage of the stock. Let's look on the downside now. In Yahoo, this was coming into October. Now, obviously, we're only going to be sellers. Why? Because price is below the 50 period. Do you see how the simple rule works? If you just apply that 50, you automatically know that you shouldn't be a buyer looking back in hindsight. But where most people have trouble is they say, okay, we've gone down low enough. I'm going to buy somewhere around here. And then it goes up a little bit. And then when it starts to come down, they're still holding on to the position. And then when it turns into a loss, well, they either buy more or continue to hold on. And then pretty soon, they've turned into a long-term investor. Okay? Does this look familiar to anybody? It's a lot easier if you would just apply a 50 period and be in sync with the overall trend. So the overall trend or the market is telling you it's going lower. Our job is just simply to jump on board. We just listen to it and do what it wants to do. So if the market wants to go lower in Yahoo, we locate the so-called oversold areas. Why? Because we know there's no such thing as oversold. It doesn't exist. Okay? Stocks can go down as low as they want. They can go down to 0. So since there's no such thing as oversold, we locate them and then we identify the bottoms that were created, as we see here, and then we simply sell once we trade 1 tick below. Now, had we taken this very first signal right here, well, that's 12 points coming into October. Okay? How about NOC? Now, this is a little bit more advanced trade here because this is where students have trouble. They say, well, Steve, we were below, then above, then below, then above, so I don't know which side to be on. It's true, it takes a little bit of experience because sometimes you will go into the whipsaw markets, but the beauty of this is that when the market is oscillating above and below, it will keep you out. So you won't be doing anything until you get an established trend either above or below. Now, while we were below, as right here, the only action we could take is if the oscillator were an oversold. And as you can see, it never got to oversold. Now, while we were above, the only action we could take is if we got into overbought, and it did. All right, so this is going to be a top we'll be looking at. Once we went below, we can only go short if we go into the oversold, which we did. So let's look at these areas. Here's the oversold, here's the overbought, and the overbought. Now, in order to go short, we would have had to trade below here, as you can see, because this is the short-term bottom. But we never did, so there was nothing really to worry about. Remember, we have to be in conjunction, not just with the 50, but also with overbought and oversold areas. So since we never went below there, well, once price crosses back up above, then we start looking at the overbought conditions. And we did go above there. We went above there here, here, and here. So these were our entry points. Okay, now we just taken this very first one. Well, that's 20 points in our favor. As you can see, the market bounced up even higher. Now, obviously, there was some news where the stock gapped up from 180 up to 190, 10 points. No one told us of that. We didn't know that there was going to be any good fundamental news in NOC. In fact, we don't even track fundamental news. We tell our students that it's not even required to follow anything concerning the company because we're not investors. We're just holding things in the short term. So there's no reason to look at news. I stopped looking at news over 30 years ago. So the point is that there's really no use in doing it. So how did we know this stock was going to go up? We simply looked at the 50-period moving average. That's all you need to know. How about when? Okay, once again, we were oscillating below and above the 50 until coming into September. We were well below the 50 coming into October. Okay, from this point on, you would have lost a lot of money trying to pick a bottom. But if we look for these overbought, oversold, we see that we never had to worry about anything being above the 50. Why? Because we never got in the overbought area. So all trades were going to be exploiting oversold conditions. So therefore, we just mark off the lows. And there were a lot of them, as you can see. And if we had just taken the very first sell order right here, now we know this is an expensive stock, but you could purchase options. It really doesn't matter. You could buy directional puts. It doesn't matter. Well, you would have gained 45 points coming into October. See how simple this is? There's no math. There's no convoluted logic. There's no type of figuring out what the news means and what it doesn't. There's no real complicated system rules. It's just listening to the market, understanding what the market wants to do, and then jumping on board, okay? Now, with this same technique just doesn't work for stocks. We can apply this to crude oil. As you can see here in commodities, we are looking at a weekly chart of crude oil. Now, crude oil has been going lower and lower for the past year. Sure, it's had some minor fits and starts, but for all intents and purposes, as we see here in this weekly chart, it's been consistently below its 50-period moving average on a weekly basis for an entire year. So we've known as far back as August, September of last year on a weekly basis that crude oil is going lower. You should not be buying it. Even when it had this little bounce, there's no reason we should look to be buying it because it would be more advantageous to just simply go short. So all you have to do is use the same technique. You locate on a weekly basis the oversold area. And look at this. We were oversold from August of 2014 to April of 2015, all right, over 6 months. Do you think you would have done well trying to pick a bottom this entire time for 6 months? Remember, there's no such thing as overbought or oversold. Don't fall into that trap. It's really a gambling mentality, and over time, it will not make you a consistent trader. It's much better if we just simply exploit it, identify all the bottoms, and if we had taken this very first signal right here, well, that's 45 basis points coming in for the past year in crude oil, all right? People would have thought you were a genius figuring out what crude oil was doing. There's no reason to be a genius. All you have to do is see where crude oil is in relation to the 50-period moving average. It tells you everything you need to know. And we can apply this to other commodities. Here's a chart of sugar. Now, I personally don't trade sugar, So I wouldn't know exactly how it works, but I'm just using the same concept. This was coming into November. This was all of October here. We were oscillating above and below the 50, but we never got in the oversold. So the only thing we're going to be focusing on are the overbought conditions. Remember, we would never care about being below the 50 because we never were in the oversold area. So why would we concern ourselves with a trade? We need this to be oversold. But since we never did, but we were in the overbought areas, let's follow that territory, all right? So we simply look at tops created, and have we taken the very first one right here? Well, we had some nice run up in October, all the way up. This is in sugar. Once again, I don't trade sugar, never have, but the same technique will apply. It's just basic market behavior. Now let's look at the E-mini now, and I want to start out by looking at an older 60-minute chart, and I'm doing this for specific purposes. This is going back to August. We all remember when the markets fell out of bed. One of the biggest problems that traders have is that they always try to take themselves out of the game. In other words, I know this from firsthand experience. I try to do the same thing, in that you try to rely on a teacher or a system or an outside indicator, something outside of you to tell you how to trade. And this is going to tell you where to buy, where to sell. And the reason why most traders trade this way is because it gives you a great out, a perfect out. Because if it doesn't work, you can always blame the system. You can always blame that guy in the chat room or trading room. You can always blame that guy on TV or that indicator, okay? When it does work, sure, you're a genius. But when it doesn't, there's always something to blame. You can be the victim because it wasn't your fault. Well, you can't do that with the way we teach here at Specialist Trading. We give you the tools and the information to empower yourself. So that when you're wrong, well, you take responsibility for it. But when you're right, it's because you made the decision and no one else. Now, so many traders in August were blaming these hedge funds and these high-speed computer programs when the market fell out of bed, thousands of points in a matter of days. Everyone was complaining. They were all saying, Steve, there's no way anyone can make any money. People were calling me up saying, how do you make money in this market? These guys are just controlling everything. There's no way that the little guy like us with a small account can trade. Okay? Well, I don't believe that. That's not true. Here is a 60-minute chart, an hourly chart, going back to a few days before that market fell out of bed. As we see here on the 19th of August, we ask ourselves, where was price in relation to the 50 period? Well, price was above, but the 19th we started having consistent closes below. In fact, we had 1 day above or 1 hour above, but then everything went below. So if we're below, are we going to be buying anything? No. So right off the bat, there's nobody to blame. You can't blame a hedge fund. You can't blame frequency trading because the market was telling you before it even fell out of bed that it's most likely going lower. On this hourly time frame, you would have known that the market's going lower. So there's no reason to lose money because you should have been only looking to short. If you don't like to short, well, then you just simply go to the sidelines and wait for price to trade above the 50 period. But as we see here, if you're an intraday trader, well, price was below the 50. So you know right off the bat you're just going to be a seller. Now, if we're using this technique, well, here are the so-called oversold areas, okay? And if we identify the bottoms, they're right here on the 19th. Here was another one on the 20th, and the day the market fell out of bed on the 21st and the 24th, okay? So had you taken that very first setup here on the 19th or 20th, that's 230 points had you stayed in for the next 2 or 3 days, okay, using this technique. That's over $11,000. So how could you complain if the market was telling you everything you needed to know? Remember, as traders, we're always looking to take ourselves out of the game. This is why the majority of traders fail, because you want to blame someone. You don't want to take responsibility. You want to have a teacher tell you, where do I buy? Where do I sell? Tell me what market to trade. Tell me what's the perfect time frame. It doesn't work like that. The only way to become consistent is to take control of your own trading. And the only way to take control is to have someone or something supply you with information that has stood the test of time. And this is what we do at Specialist Trading. So as you see here, none of our students would have lost money when the market fell out of bed. Why? Because they were just simply applying that simple tool of the 50-period moving average. Now, if we go to a daily chart, just until last week, the market had been steadily going higher and higher and higher. A lot of people were saying, boy, I don't understand. Why do we keep going higher? The entire month of October, we've been going higher and higher and higher. Remember, we don't care what the reason is. We're not looking, it doesn't matter. Whatever the market wants to do is fine with us. Our job is simply to identify what the market wants to do and then jump on board. So as early as the first week of October, we had consistent closes above the 50. So that was telling us we're going higher. There's no reason to try and figure it out. There's no reason to listen to news or look at a ton of indicators. Just we see that the market was above the 50, so now we're going higher. If we're going higher and we're going to use this technique, we're just going to simply exploit the overbought conditions. So you see here for almost the entire month of October, we were overbought. Remember, there's no such thing as overbought. So we just want to identify the tops. And had we taken that very first signal at 70 points or $3,500 in a couple of weeks just using this simple technique. Now let me show you something that happened yesterday, all right? Not just to show you that we're cherry picking or looking back weeks or months. This happened yesterday. If you're an intraday trader trading the E-mini, here's a 5-minute chart. Well, we all know at the end of yesterday, if you're an intraday trader, we had a really nice rally at the very end of the day. This is where you see a lot of these really nice setups, either at the beginning of the day or the ending of the day, because that's where the trends are, okay? During the middle of the day, that's where all the specialists and traders go to lunch, so there's not a lot of action. But the beginning and the end is where people are, starting positions or squaring up positions, and this is where the trading actually happens. So as we see here, roughly about 9 o'clock Pacific time, that would be 12 o'clock noon going forward onto that, we were above the 50-period moving average, okay? So we knew as intraday traders on a 5-minute chart that we're only going to be looking to go long. Had we tried to short this entire time, we would have lost a lot of money, okay? So there's no reason to short. It doesn't matter what an indicator is telling you, what some guy in a chat room is saying. Don't listen to them. Only listen to the market. And the market was telling us as far back as here that we're going higher. So if we're going higher, we want to exploit overbought conditions. Why? Because there's no such thing as overbought. And here are the tops that were created all the way, going all the way up the last 2 or 3 hours of the day. Remember? Those are the tops associated or that were made while we were in the so-called overbought conditions. And all you had to do if you had taken the very first setup, once we traded above, well, that's 22 points, roughly a little over 22 points you could have made in the last 2 or 3 hours of the day. That's roughly $1,100, okay? Now remember, once again, we're only going to take questions at the very end. I know a lot of you may be having questions worrying about stops or asking particular stocks. Remember, as I stated in the beginning, hold questions to the very end, okay? All right, so let's look at the Forex markets because we will still see the same phenomena in any market in any time frame, okay? So I don't care if you trade tick charts, I don't care if you trade monthly bars. You're going to see the same thing because it's market behavior. Market behavior never changes. Here's a daily chart of the Canadian dollar coming into October. All right, let's ask ourselves, starting at the beginning of this chart, where is price in relation to the 50-period moving average? Price is above, correct? So if price is above, are we going to even be trying to sell the Canadian dollar? No. What if someone tells you, hey, we've come to some tremendous Fibonacci levels where there's tremendous resistance. In fact, all the institutions in Europe are selling the Canadian dollar here. You should be selling right here. Are you going to be selling? No, because the only thing you should be listening to is the market. That's the source of everything. So if the market is telling you it's going higher, what do we want to do? We just want to be buyers. We're not going to sell the Canadian dollar until it goes below the 50. It's that simple. So if price is above, then we're going to exploit so-called overbought conditions, as we see here circled in green. All right. Once we find them in green, we identify the tops. That's simple. And if we had taken the very first signal here in July, which, as I stated, has the most bang for its buck, well, we would have purchased here, and it would have given us 700 pips room to move. That's roughly $7,000 in our favor. It went after that. Okay. That's a daily chart of the Canadian dollar. Let's look at a weekly chart of the Australian dollar. All right. Once again, where is price in relation to the 50-period moving average? Even though this is a weekly chart, where is price in relation to it? It's below. Would you have made any money listening to some guy in some chat room telling you to buy the Australian dollar all the way down? No. You would have lost a lot of money. Why would you waste your time subscribing to that? Why would you waste your time buying some perfect system to pick bottoms and tops? Why not just plot a 50-period moving average? You already have it on your charting software, and you could just use this and you know what side to be on. It's telling us we should only be short. If you don't like to short, then go to another market, okay? Go look for a market that's above its 50-period moving average. But if you do like to go short, well, then you want to exploit the so-called oversold conditions. Now, do you see here, this is a perfect example where my mentors taught me, and which I stress tremendously, is that there is no such thing as overbought or oversold. The Australian dollar has roughly been oversold since September, October of last year, all right? When's it going to stop being oversold? Don't you think it's kind of foolish to try and stand in the way and think that we can pick a bottom and we can pick an exact moment when it's going to stop? It's silly. It's a lot easier to simply exploit these levels, identify where the bottoms were, and then use those as our entry points. Had we taken the very first one and held on, I'm not saying you would have, but you had 1,700 pips in your favor. That's $17,000, okay? So that's the beauty of this. You're seeing the consistency in this, whereas when you trade the other way, there really is no consistency. Sure, you will have winners. I'm not going to tell you won't. You will have some winners every once in a while where you'll see a top that is above the 50 and a bottom that is below the 50 that works like magic. And you'll kick yourself and you'll say, boy, why didn't I buy there? Or why didn't I sell there? But trust me, those are few and far in between. And you'll probably maybe have one or two of those, and then the next one you'll give it all back. Trust me when I tell you it's very similar to playing the slot machines, okay? They give you the same false sense of security every once in a while by giving you a winner, and you think, hey, I'm doing pretty well. I'm hearing all the bells and whistles. I'm hearing the clanging of the money. I must be making money over time. But if you look over time, and if you play long enough, you'll see that you've actually lost money. It's the same way with trading tops and bottoms the traditional way. Every once in a while, just like a slot machine, it will give you a winner, and it'll give you this false sense of security thinking you're doing well. But really, the majority of us will not make any money. Only 1 or 2% of traders will be able to trade tops and bottoms consistently and successfully. Myself, I've never been able to do it, and the majority of traders aren't either. So isn't it a lot easier just simply to go with the market? Why swim upstream when you can swim with the current at your back? So 2 important points to remember before we go to question and answer. Extremely important. Once again, just as my mentors taught me, you must grasp this concept and really give into it, because in reality there is no such thing as overbought, oversold. All right, they don't exist. They're illusions. There's no such thing. We've seen markets go up as high as they want. I just showed you examples of markets going up for months, and I showed you examples of markets being oversold for years. Isn't it silly to try and think we can pick a point where they'll stop doing that? There's no consistency in that. So you really have to get this concept that there's no such thing as overbought and oversold. And once you grasp that, then you'll never ever want to try and pick tops and bottoms the traditional way, because you'll know there's no consistency. There's no consistency at all. And remember, that's what we're trying to teach all our students. We're not trying to promise everyone they're going to be making millions, they're going to be buying their home in the next 6 months and consistently making thousands of % a month. That, we don't believe in that. What we do believe in is sharing and teaching and mentoring our students techniques and information that has stood the test of time, that if used properly will instill this sense of consistency in your trading. And that's what we're trying to do, because consistency is what will sustain you 10, 20, 30 years down the road. And that really is what successful trading is all about. Not making millions of dollars. I knew tons of traders on the floor. I was in a room of about 250 traders on the trading floor. And I came in contact with a number of traders who in a relatively short time made hundreds of thousands, if not millions of dollars almost overnight. And guess what? Not one of them is trading today. I'd say maybe out of all that 250, maybe 2 or 3 is continued trading. The majority of them are not. So what good is it to make a quick killing if you can't sustain it? Success is really about sustaining, and the only things that will sustain you is sound fundamental education and information that has stood the test of time. This is what we provide all of our members at Specialist Trading. So, in conclusion, before we go into question and answer, I want you to ask yourself, and ask yourself honestly, do you think any of these edges could have helped your trading this past year? Go back and look at your last 10 or 20 trades, okay? And ask, if you would have applied just 1 or 2 of these things I shared with you today, could they have helped your trading this past year? Now let me just show you one last time how important just one of those edges was, okay? The 50-period moving average. Looking at this chart here in TE in September, all right, someone would say, well, Steve, there's no real trend here. We're just in a range. We're going sideways. So I'm not going to get involved. Even though this stock interests me, I've heard some good stuff about it, but you know, I want to see some more action involved. We're just basically treading water here. So I'm not going to do anything. This is the way most people trade, okay? Not at specialist trading. The first thing we do is apply the 50-period moving average. We ask ourselves, where is price in relation to the 50? Price is above. So actually, the market is telling you a lot. TE is telling you we're in an overall uptrend. If you're going to do anything, you should be a buyer, and you should look for setups to go long. Because if you don't, you may miss opportunities like this. Now, once again, we didn't know the stock was going to gap up much higher. No one told us. The only reason why we thought we should be long this is because we're above the 50-period moving average. Works the other way as well. Here's a very current chart of FOSL. I hear this all the time. In fact, this chart was taken up into the last day or so. Traders are saying, boy, you know, Steve, I subscribed to this educator about support and resistance or whatever, and they told me to buy somewhere here on this double bottom. This is where all the institutions were coming in. So I bought. It went up a little bit, and then lo and behold, look what happened. I mean, what happened with all the support? You know, this stuff, how come I always get caught in all this stuff? Where am I supposed to learn how to trade this stuff? And I always tell them, well, didn't you apply the 50-period moving average? Because had you done that, you would have known months in advance that price was below the 50, and you had no reason buying anything. I don't care what some guy in a trading room told you. If price is below, why would you buy it? Why would you step in front of the market? The market is telling you, in fact, it's screaming, I'm going lower. It was screaming it was going lower back here months before because it was below the 50. So right back here, you should have known I'm not going to be long this stock. This was at 60, and the stock now is in the 30s. So here's what we'd like to offer all of you today. All right, this is our Secrets of a Stock Exchange Specialist training sessions. What it is 3 hours of trading techniques plus a full strategy. About 3 years ago, I was asked to speak. I was asked to be the featured speaker at a conference in Denver, Colorado, and they videotaped the entire 3-hour session I had. Okay, in this 3-hour speech I gave many more high probability trading edges, very similar to the ones I gave today, but entirely different. But high probability edges that I learned from the floor, such as which indicators to use, which ones not to use, the difference between a system and a strategy, plus the #1 chart pattern you should be looking for. But the most important thing that I talked about in this 3-hour session was that I gave all of the complete rules to one of our best pullback strategies. That's strategy #1. Now remember, if you remember today, I didn't give you a full-fledged strategy. All I showed you was a particular entry technique, all right? I'm going to share with you in this 3-hour video seminar a full-fledged strategy, the entries, the exits, stop placement, money management, how to trade aggressively, how to trade conservatively. In fact, let me show you some current signals that were generated. The beauty of this particular strategy is, like, unlike what I share with you today, this is a pullback strategy, meaning that in an uptrend, we like to buy at the low of a sell-off. So as you can see here, BBY, for all intents and purposes, was going much lower. A lot of people thought the stock was headed much lower, but strategy #1 generated a buy signal because it said that this was just a pullback in an uptrend. And the stock went from 35.5 to 36 or 38.5 in just a matter of days. It also works to the downside as well. Now, this is an over-the-counter chart in Volkswagen. We've all heard the news recently about all the false emission reports that the CEO generated and ultimately resulting in the CEO resigning. A lot of bad news, but as far back as August, strategy #1 was generating sell signals. Every time we had a nice bounce to the upside, a sell signal was generated at the top, and look what happened. Another bounce was generated, excuse me, and ultimately the stock fell out of bed, okay? So it works in uptrends and downtrends. It also works in the currency pairs. It looked as if the euro dollar was rolling over here last month, but strategy #1 said this was just a sell-off in an uptrend, so it generated a buy signal. Remember, the beauty of pullbacks is that you get to purchase at a much cheaper price, and the euro dollar went up quickly in the next week. And then this was just a few weeks ago, a 5-minute chart of the E-mini. As you can see, we're in an overall downtrend, But in a downtrend, we had these little fits and starts, these little rallies that would fizzle out and come lower, a rally that would top out and come lower, and so on. What if we had some type of strategy that could tell us when to get short on all these little rallies? Well, we do. This is strategy number one. It works in any market, in any time frame, and these were all the sell signals that were generated in this 5-minute time frame of the E-mini. So all of the rules, everything is included in this 3-hour video seminar, along with many more high probability techniques, just as the ones I share with you today, but entirely different. This is all included in 3 hours, jam-packed, full of information on a video seminar, which is a online presentation. Now, it's got so much information, and it really is a course within itself. My sister site, Pro Trader Strategies, they market and promote this course for close to $1,000 on their website. But for all the attendees today, taking time out to come hear me speak this evening, I appreciate it. We're dropping the price tremendously down to $37. But this is for a limited time only. In fact, I believe this is just until tomorrow, where you're going to get all this information, all the high probability edges, this full strategy for $37. I can honestly say most of you may have spent more than that just trading today. Just the price of commissions on your trades today probably reached higher than $37. So here's how to take advantage of this great deal we have. Once again, it's for a limited time only. It's just for the attendees today. It's a full-fledged strategy. And as you see here, Pro Trader Strategies, their email address is trading@protraderstrategies.com. Their phone number is 310-598-6677. And the link that will take you directly to that sign-up page is right here on the bottom. Here's the only trouble, though. This is not a live link. You'd have to copy and paste this on. But if you go to your chat box on GoToWebinar, right there on your page right there, you'll see that they've posted a live link where it says to lock in the $37 offer, use this link, and that's live. So all you have to do is click that on. It will automatically take you to the sign-up page. You just give a credit card number, and you'll be up and running in a matter of moments, okay? Once again, this is going to go back up to the $997 price in just a few days. So we really strongly suggest that you take advantage of this deeply discounted deal. 3 hours of information that people paid good money to come see me speak in person that we have on a high definition quality online course for you, okay? I'm going to leave this information. If you're having trouble getting on to the link, you can call up or email Pro Trader Strategies. They'll set you up over the phone or email you back. But you should have no trouble. Just go to your chat box right there on the far right and just click on that live link. Now, I want to thank you. We have some time for questions and answers. I want to thank you now. I'm going to open up the question and answer box right now. And let's see, does the FIFO rule for long and short still apply? First in, first out rule, I assume. I'm not really sure. Could you go into detail more about that first in, first out rule? I'm not really sure what you mean by that. Marty asks, you can make money or you can make excuses, but it's difficult to make both. Yes, it is, but unfortunately, most people like to make excuses, and that's why most traders, in my opinion, fail. And I say this from personal experience because I did the same thing. I'm not going to put myself above anyone. When I first started trading on the floor, trust me, I had maybe 20 indicators on my screen. We didn't have chat rooms or trading rooms back then, but we had newsletters. I subscribed to each and every one of them. I waited with bated breath on every news announcement, from jobless claims to the money supply to earnings. So I couldn't make a decision. It was just unbelievable how I was even able to trade because all these things had to match up. But when I did, sure, I would have maybe 1 or 2 good trades, but I can remember going months where I'd have disastrous months where I really couldn't make a dime. And it wasn't until I simplified my trading and started to take responsibility for my own trading. And the way I did that was simply releasing all of these outside sources that really weren't helping me. You know, we rely on all this outside information, all this fundamental stuff to tell us how to trade and how to be, but in reality, it doesn't exist. It's not real. It doesn't help us anymore. So the only thing we should be focusing on is the market in front of you. That's where all the information comes from. That's all the thing you need to know. If we're above the 50, you're going to be a buyer. If you're below the 50, you're going to be a seller. Right there, in my opinion, you've eliminated half your losses because you're in sync with the market, okay? George asks, your opinion about using Bollinger Bands, Ichimoku, Dorian, RSIs. Well, those are all valid tools. I mean, we do use other indicators, very simple, basic indicators, but we use them in the right context, okay? In other words, we don't rely on them. We just use them for different, for things to help us with our entry or things to help us with our exit, but they're not the all end with, with everything. Basically, we're looking for market behavior. Maybe these tools will help us discern what the market behavior is, and then we just want to jump on board. So don't put too much credence in overusing indicators. It's no different from putting too much emphasis on too much news or listening to too many chat rooms or trading rooms, because once again, if you do that, you're taking yourself out of the game. All right, our goal is to keep you in the game. We want you to make your own decisions. A lot of people will say, well, Steve, how can you do that when you supply your students with strategies? Don't these strategies tell you where to buy and sell? Yes, they do. But what we do is we provide our members and students with basic formats. These are basic formats. So if you've been trading a week, or if you're a hedge fund manager who's been trading 30 years, you're still going to get the basic format. But then I supply you with all the insight and information and techniques I've learned and accumulated in 38 years, so you can add and pick and choose to those basic formats to fit your needs. So we can have two traders have the exact same signal, but they'll get different results. Someone may make a couple $100, someone may make a couple $1,000, someone may break even. Why? Because they're trading them under their own personal guide. In other words, they're trading in their parameters. So that's what we teach. That's the only way you're going to become consistent, by making yourself in charge of your decisions, okay? George asked about Donchian. Yes, well, Donchian is an indicator we use. In fact, we use it with a strategy of ours. But, once you become a member, or you are a member of that particular strategy, you'll understand how it's applied, okay? And it'll help you a lot. But those are all great tools. We just simply, use them to help us format and to find certain areas within market behavior. Edna asks, is the 50 XMA or SMA? Well, that's a great question. She's asking, is it the exponential or the simple? They're really, it's not a rule written in stone. You do not have to trade simple moving average. I prefer the simple moving average because in my 38 years, it fits the best with all markets and all time frames. You see, we want to keep things as simple as possible. That means we don't want to change or edit the parameters with each market. So if we go to a currency pair, we say, well, we're trading currency pairs now, so now we look at a 100 period. Or now I'm trading a 5-minute E-mini, so now I go down to a 10 period. We don't want to do that. That's what complicates your trading. You keep things simple when everything is always the same, no matter what market, no matter what time frame. And in my 38 years, the 50 period simple moving average seems to fit the best, okay? The exponential is okay. I prefer the 50 period simple moving average. Now, having said that, there's nothing wrong with using the exponential. The main thing I want to get across with this concept is that if price is above, you should only be buying. If price is below, you should only be selling. So the moving average is not a system. It's not a strategy. It doesn't tell you that you buy immediately once price crosses above or below it. It's just getting you on the proper side of the market. Now you have to put together some structure. And that's what I teach and mentor in my courses. I give you that structure. So this is just telling you, okay, what side of the fence am I on? And now you know what side of the fence you're on. Now you have to apply some type of structure, okay? Punil asks, are your rules enough to trade Forex successfully? Well, yeah, but remember, successfully is subjective. Everyone's going to trade differently. As someone may trade it. We have traders who have traded the Forex who trade all my methods on a tick chart. And they say it's fantastic, okay? Now, I can almost guarantee you, if you are a swing trader and you apply my methods on a tick chart, you'll lose money. So relatively, that's saying you're not successful. It's all about finding the correct time frame, finding the correct market. We feel the methods are successful in terms of being consistent, but it's up to you to decide how to trade it. You're going to determine your success, not the method. It's you who are in charge. Remember, this is what I stated at the very beginning. Most traders take themselves out of the game. That's why they're not successful. A strategy does not make you successful, okay? A teacher does not make you successful. A market does not make you successful, or a time frame does not make you successful. You make yourself successful. I provide you with the tools and information, and I teach you and mentor you, but it's up to you to decide how you want to implement that. Now, if you don't believe that or trust that, do a Google search on myself or on Pro Trader Strategies or Specialist Trading, or go to the blogs. You'll see so many students who were inconsistent for years, who after using our methods have become consistent for the first time, because they put their selves in charge for the first time. Okay, so that's what we're really about. Punil asks, are the PET D and strategy number 4 enough to trade Forex? Well, first of all, when you say enough, I mean, all I can say is the PET D and strategy 4 are very good tools. In fact, they're probably our best program to date. They work well in Forex, but remember, it's going to be how well you study. The answer is not in the PET D and strategy 4. The answer is in you and how you apply them. So trust me, I work with you alongside Punil so that you understand how to implement them. But I don't want you to think that the answer comes from, because it's no different than you've turned this into a chat room or a trade room. You've turned my methods into something where, tell me what to buy or what to sell. That's not the way they work, okay? I hope you understand that. Yes, they work on daily charts, though. These techniques and applications can be applied to daily. I showed you tons of daily charts. I showed you daily charts in the Forex. I showed you monthly charts or weekly charts in the Forex. I showed you 5-minute charts in the S&P. I showed you hourly charts in the S&P, and then I showed you daily charts in stocks. So you see how they work in all markets and all time frames. It's just how you know how to apply them, and that's where the core of our website is. We teach you on hands-on basis. Okay, so it's all about mentoring and teaching you so that you can ultimately go on to make your own decisions. Okay, as you can see, I give a lot of attention to detail about that because that's our philosophy. We're not like other websites where I say, I've got the perfect strategy, it works in any market, you know, here's the best market to trade, it'll make you money, come buy this. I don't believe that. I think that I have information that has helped sustain my career, that has helped hundreds of students. Our methods are traded in over 92 countries around the world by people who are trading for 2 weeks, and also by people who have been trading hedge funds for 30 or 40 years, and they're traded in every state in the United States. So there is some consistency there, but it's up to you to decide how to process this. And this is what you do from someone who's been trading for 38 years. I mentor and teach you along the way, okay? Remember, this great $37 deal is only going to last through, I believe, the end of tomorrow. After that, it goes back to $1,000. I don't think you want to spend that much money to get all this information. You're really going to miss the chance if you don't just put out $37 to get a full-fledged strategy, strategy number 1, along with tons more of information, just like I shared with you today. I don't think you can even go out for dinner for 2 people less than $50 these days. So $37 is a great deal, okay? In conclusion, please contact Pro Trader Strategies. You see there's the link at the very bottom, or if you go to the chat box on the far right, that's the live link, if you haven't taken advantage of it by now. And if you want to take your trading to the next level in 2016, if you're not anywhere near where you thought you'd be in 2015, 2016 is just around the corner. Here's a great way to get back on track, okay? And for such an inexpensive price, $37, it shows you in good faith that we really want to teach you and help you to become a better trader, okay? I want to thank you so much for attending today. I look forward to all of you becoming members of Specialist Trading, and most especially I look forward to all of you becoming students of mine, and I can be your mentor. Thank you so much. I'll see you next time. Bye-bye.